I only specialize in what I call the really great bubbles.
What is going on, YouTube? Welcome to the Sunday kickoff show for the S&P 500, the Russell, and I'm going to give you a trade update on that silver short that I shared with you guys, the setup for it, I guess, 2 weeks ago now? Let's see how that's playing out. But guys, I was looking at the YouTube comments from the last video where I said, my thumbnail said Powell lied. I went over the leading economic indicators, how they're flashing hardcore recession. I went over the bond yield curve inversion. I went over the fact that the 40-year high inflation, the fact the market's never bottomed before recession, and a couple of guys went absolutely ballistic, I guess saying things like, me and my banker buddies just want everybody to sell so we can buy everything at cheaper prices, everything's going up. Yeah, I get that narrative, guys. I was thinking about that, like, why is that somebody would look at market facts? Because certainly I'm giving my opinion based on the market facts, but why would you look at a set of market facts that have been 100% accurate since the early 1970s bubble, okay? 100% accurate, predicting a recession, giving you an average of where the S&P will decline to. Why ignore that? And I think I distilled this down to my appearance. With my shaved head, my goatee, I look like a James Bond villain. I look like somebody you send out to assassinate James Bond. I look like the guy that you send out to kidnap Liam Neeson's daughter, right? Like in the movie Taken. So I thought what I would do was invite a professional into the marketplace here and to the show, Eric Johnston from Cantor Fitzgerald. I wanted to invite him and his amazing head of hair to share with you his perception of what's happening in the marketplace, the indicators he's watching in the marketplace, and if he thinks it's important to look at the data as it is and look at what the market facts tell you. So Eric Johnston, I appreciate you being here. I'll go ahead and yield the floor to you for you and your head of hair to tell us your thoughts on this marketplace.
Yeah, so thanks for having me. So I think the important thing is to go to the numbers. And, right now, the market is trading at 18.4 times 2023 estimates. Those estimates, I think, are far too high. But if we put that aside, 18.4 times is a 50-year high, X the two bubbles, post-COVID and the internet bubble. So you have to believe that we're going to go into a third bubble in order to get valuations such that you actually have upside for this market. Right now, the earnings yield of the S&P 500 is about 5.4%. Money market yields are 4.5%. It's about an 80 or 90 bip spread. That's the tightest spread since July of 2001. One of those bubbles that I was referring to. So the argument for a soft landing, I think, is it's possible. It's unlikely based on what the yield curves are doing, the leading economic indicators are doing, the lag to the 500 bips of Fed hikes we've just had, but it's possible. But my question would be, in that soft landing scenario, what are the earnings in 2023 and what's the multiple that's going to be put on those earnings?
Eric, I mean, I've got, yes, the yield curve is inverted. We know what that traditionally means. Yes, the leading economic indicators are telling a difficult and perhaps stormy story. But on the other side of that, I do have a consumer that I'm sure has surprised you in its resiliency, at least to this point, that maybe this recession, if it even is one, doesn't look like ones of years and decades past. And that's what keeps us chugging along to the degree that Ed thinks we can, and the stock market doesn't fall apart as a result.
Well, I think the recession doesn't need to be a deep recession for stocks to go down a lot. That happened, if you look at the recession back in the internet bubble of 2000 to 2003, that wasn't a deep recession, yet stocks went down 50%. And the issue that we have right now is that because of the multiple of stocks, just to go to the average, if you go to a 15 and a half multiple on the S&P, you're talking about down about 20% from here. And that's not even counting the fact that if you look at earnings estimates right now, it's not like earnings estimates are trough estimates. We are well above trend. If you draw a trend line over the last 20 years of earnings, we are well above trend, operating margins well above trend. And so those estimates have significant risk to the downside. And by the way, we've been talking about this for 6 or 9 months. And over the last 6 or 9 months, they've been coming down. And we think that they have a lot more to go. And the other point I would make around the Fed is that, yes, they are almost done, okay? But the issue is, saying they're done, if they were to raise rates tomorrow to 10%, but say we're done, well, that's not good news. And so the point is that, yes, they're going to be done. They're going to finish at 4.75, 5.25. But that kind of Fed funds rate of 5% for many months and quarters to come, that's very problematic for multiples. And that's going to be a big headwind for the economy.
So the key takeaways for me, and thank you, Eric, for coming on the show. The key takeaways for me are to understand and to believe that the market is going into a new bull run, to believe that there is a dramatic upside. You have to believe you're going into yet another bubble, and you would be performing this inflation of the bubble without the $7 trillion in stimulus that was necessary to pump up the S&P 120% in less than 2 years, where your average return would have been 20% since the great financial crisis. Do you understand that? You 6x'd your normal return for that time frame. You made a gigantic bubble. So again, these are just market facts, data sets, okay? The 3-month 10-year yield inversion has a 100% hit rate for predicting a recession. You do not need a strong recession to have massive collapses in equity prices. So we're going to look at this into the charts, and I'll give you guys what I think's happening here and what I expect price to do. And let's go ahead and kick this off. Guys, this video is going to be presented to you by SimpleFX. If you want to trade these global equities, indices, Forex, commodities, as well as cryptos on an exchange where you can trade everything anonymously with a VPN. You can trade everything in USDC. Your money's held in segregated accounts in cold storage. No withdrawal limits, no deposit limits. You can deposit $1 million day one and take it back out the same day. Check out SimpleFX. It is a fantastic exchange. It's where I trade. I pinned it in the YouTube comments, also in the video description, with our double market makers instant bonus up to $5,000. Let's go ahead and jump into this. So guys, everybody has seen this, right? Everybody, these market technicians you see on CNBC that do basic TA, everybody had this simple trend line, right? And then what is this price action right here? The breakout of the trend line. This is super bullish. This time it's different because this got rejected. This got rejected. This got rejected. But now this time is different. We are off to the races. Well, is this as bullish as you really think it is? Let's look at this from an advanced Fibonacci geometric perspective and utilizing Wyckoff for market structure. We have a breakout of a trend line on the 3-day chart here, okay? We have price floating right here. Well, let's just put this in Wyckoff first and see what appears here as we do this. Go ahead and get my trend lines. Go ahead and take here this climax candle and come up here to the reaction candle. And you can see this move up that we talked about to defeat the Dow theory bear market, which is right here at 4208, okay? That's your 20% wave decline and your move up to defeat this market. 4208, that failed right at the trend line, came back down. You got down thrust here in the range. Price moved back up, rejected once again by the trend line, big Fed wick December 13th. Now you have your lower high structure. Price broke above the trend line, but according to Wyckoff market structure, all you're doing right now is making up thrusts in the range. If you do not flip 4170, last video I gave you that 4180 using this larger wave projection. If you do not flip this, you're going back down, and this could be your retest of what? The magical, mystical trend line, okay? But let's look at this from some advanced perspectives here. Could you have determined that this was strong resistance just with Wyckoff? Yes, you could. Now we need confluence. As traders, we always need confluence. Guys, I use volume weighted indicators heavily in my trading. The reason being, people ask me all the time, how come you only use like the 200 simple and the 50 simple moving averages? Those are lagging indicators, okay? We're going to look at that on the daily, but they're lagging. Volume is a leading indicator. This is why all of the great traders, talking about W.D. Gann, Richard Wyckoff, Gartley, they all understood volume analysis analysis was necessary for determining the true trend and strength of reversals in the marketplace. So let's go ahead and do a couple more things here. We have this bullish Gartley base that I've been talking about for weeks as this was forming, right? And this has targets that you can get to. Let's see if we have any of these targets here. We're going to take our trend-based fib, take that base here to that swing high here, and then the low. And you can see we got up to the 707, the sacred slice, 41.95. And actually, guys, we put a short on our Discord. If you want to check out our Discord, that link is in the video description. I put a short in the Discord here up at 41.80 right after I made that last video. And we are sitting here at 41.35. Nice retracement so far. Nice $45, $50 retracement. And the way you can do these little day trades like this, the way I do these little day trades like this, is got a nice little move down. I move my stop loss to break even. I am free rolling this. If the markets want to pull down more this coming up week, well, then that's great. I'll have a big drop in the market with some leverage applied to this trade. Or if you were scalping this type of move with some leverage, as my friends in the UK say, applied to this trade, you already have a very nice move with a $50 move in the marketplace. So looking at this, we hit this target right here. Now, I've told you before where you could get to with this pattern here. This is my chameleon pattern based off that Gartley structure, okay? Where you could get to if the market wants to flip this 41.70, 41.80 is this 43.74 target. This is a bearish pattern where you will have a reversal most likely at point D if you believe the market is going to fundamentally deteriorate as the year goes on, which I do, okay? So if you don't believe that, if you think big tech, which just had its worst quarter reported, talking about Apple in 6 or 7 years now, Google missing on the top and bottom lines, if you think next quarter is going to be better, well, you could have a different view of the marketplace, guys. Divergent views make the market. But 43.74 would be my peak. Now, is there any other way? We have fibs, of course, and there's multiple fib levels. They carry different weights of importance, as you guys know. Is there any other way we could have determined that this would be very strong resistance? And the answer is yes, with volume, weighted indicators, and different ways to track volume. And if we look at our anchored VWAP, guys, let's throw this at the all-time high. Volume weighted average price. Look where your impact was. Right at the same fib level, right at the top of your Wyckoff market structure, 41.98. Okay, you see that? 41.98. This is your volume weighted average price. Notice what price did here before, got above the VWAP, and now it came back down. Now we're right at the VWAP. So where can this retrace to? If we do start to fail here because we're overheated in the marketplace, let's look at this a couple different ways. Let's look at our money flow index. Bill Williams designed this. This is a volume-weighted RSI, looking at our historical peaks here, going all the way back to November of 2021. You can see we've been hitting this trend line here, right? Well, we just struck the exact same trend line and got rejected off of it. Looking at our Williams accumulation distribution, this would be Larry Williams, fantastic trader. Look at the volume. Volume is down left to right. This is exactly how Gartley described he wants to see this pattern play out. Increase volume, let me open this up, increase volume on the selling, and then look at your volume down, left to right, divergence building here in price. This is how you make tops. Just so happens, coincidentally, perhaps not coincidentally, to be at the top of the Wyckoff trading range as well. The Williams accumulation distribution line looks pretty flat, right? What do you want this to look like in a bull run? Well, let's look at it in the bull run. This is what you want it to look like. You want it to be above the moving average, the blue here. You see this? Wave of buying volume, working your way up to your distribution top where you now have waves of selling volume. And this is where you're at right now. You have a little bit of a baby wave, okay, here on the 3-day chart. But you have negative volume momentum, low volume at key resistance area. This is going to me, if you don't flip this 41.70, like I've been saying, 41.70, 41.80, come up on top of your Wyckoff trading range, which means you're basically getting on top of your VWAP. You're going to come back, you're going to pull back for a retest and pivot out. That's the move you have to make to get out of this trading range. What I think is more likely to happen is you're going to get some retracement. Where could this retracement go? Well, let's go ahead and do this. Let's take our trend-based fib, open this up some so you guys can see it. We're going to go to this blue candle, not using that Fed wick candle to stay consistent here, down to that swing low, up to that current swing high. The market symmetry here is 38.57 for this move. So what would this look like? Let's go ahead and do this. Open this up a little bit more. Pull this. This would be this movement here, your 1 spot 1 2. This would basically be your 1 spot 272. And then this would be this retracement to your 786, which is basically your 795, and get exactly on it. 786. And look where that lands you. Right back on the trend line. Okay. Geometric concepts here in the marketplace. So if we do not see a flippening of 4170, I'm expecting a pullback retracement. That retracement, utilizing market geometric concepts, could bring you back down to the 1 fib at 38.57, making this a highly valuable trade. And we could, of course, see more up thrusts into the range here. You could see higher moves up. The key is flipping it and holding it for support, because if you just flip it and fall back down, that's not holding it for support. You got to get on top of the trading range, get your pullback, pivot out. This is breaking out on top of your trading range. Here's your pullback, and you just fell down. Okay, so this is what you want to see, and this is how you can trade these marketplaces, understanding, utilizing volume concepts, volume spread analysis. Wyckoff was big on volume. All the master traders were. MFI rejected from the trend line. Again, guys, you know, this is what I'm looking at here in a marketplace. This is why I opened a short. This is why my short is in a free roll. So it doesn't matter to me if it pumps up. I lose nothing. Of course, individual traders should make individual decisions for themselves, and a lot of people like to scalp, and a lot of people do that frequently on our Discord trading room. Let's go ahead and jump over to the S&P on the daily, because on the daily you have some bullish indicators here. Again, lagging indicator, the 15 to 200, and I never responded to my own question. Why do I use the 15 to 200? I've said this many times, because 43% of the indices are traded with algorithms. Most common algorithms, some of the most common algorithms are the 50 simple, the 200 simple, and volume weighted average price. Okay. So I want to see what they are looking at, they being the big money, the composite man. Wyckoff said, view the whole marketplace as a single entity operating against you. So I want to see what they are looking at. Same exact thing here, guys. Lagging indicator, okay? You did not get your bullish cross basically until this last 3-4 candles here of the pump. You missed all of this, okay? You missed all of this pump up. So this is what I'm looking at here on the daily. If we want to look at the daily here, let me get rid of that. Let's go ahead and do this. Open this up. Bearish divergence on the volume weighted RSI, our market makers money flow index. Guys, a custom made indicator you do get for free when you join our room. So check that out. You get a bunch of indicators actually, including this V-Rock beneath me. So let's look at this here. So you have bearish divergence, money flow making lower highs, price making higher highs. Once again, going back to that 3-day chart, guys, the top of the Wyckoff range, you have various patterns appearing here as well. So this is an area where I think you're going to get that retracement. And let's look at our volume. Let's check out our volume range here. They changed the name of this. You know, it used to be like VPVR. Now it's VRVP. I don't know. So visible range, volume profile. Look at your peak volume resistance again in this range going all the way back to April of 2022, almost a year. You're right at your peak volume resistance, even without fibs. You got above it and you closed below it on the next candle. You actually closed below it on that candle that you got above it on. Okay, so peak area, high confluence area for resistance. And this is, you know, you're back at 41.35. So everything for me on the SPX is going to boil down to flipping 4170, 4180, holding it for support and moving up. If you do not, then you are moving back down in this geometric pattern here, reciprocal move back down to your trend line right there around 38.55, okay? And then if this bounces back up here in the 3-day chart, if this bounces back up and makes a lower high, that is bearish. Then you have a series of lower highs, okay? There's your high, your lower high on your rebound, your lower high again, and you have to watch price descend. As you guys know, looking back on the weekly chart, we're looking at the spring equinox, which is a pivot, okay? A key market pivot is the spring equinox that is slated for March 20th this year. This could mark a market top where it triggers a sell-off. This could be the market bottom. That all is going to depend, with Powell being super dovish like he was. Does the rally want to continue? Well, then that spring equinox could be the trigger for your sell-off like you had in .com. If the rally starts to fail here and never goes up to that 4,300 level, this could be your market bottom in that quadrant, that March 20th to early April quadrant, just like it was after the great financial crisis, S&P 666 and March. Spring and fall equinoxes, guys. My first SPX video I did, that was an individual video. If you go back on my playlist and look, you will see it's all about the equinoxes. They are major pivot dates in the marketplace. Let's go ahead and look at the Russell. Looking at the Russell, guys, 3-day chart. Again, peak volume resistance right where you're at right now. Let's go ahead and map this out. We have our same exact bullish Gartley structure here as well. Where's my brush? It's down here. All right. So bullish Gartley structure, okay? This is your movement here. Your sell off, your move up, move down, move back up. Again, exactly how you want to see the volume. Volume increase on the sell off, got some momentum here picking up, but volume is down left to right. Again, this gives you a high probability trade setup here. And so let's go ahead and map this out, the trend based fib. Swing low, swing high, swing low. There's your 1 fib, the market symmetry, geometric trading, 1988, okay? Price is at 1986. Peak volume resistance right here, 3-day chart. Let's go ahead and draw this guy out. This will be my chameleon pattern once again, or a geometric Gartley, whichever you wish. And let's go ahead and come up. 946 here, so you can see this move right here, okay? So this is exactly where we're at. Peak volume resistance, 100% retracement of the move. I like this trade setup too. Low volume, okay? Low volume is key. Let's see what we have here on the 3-day chart. Again, historic trend line. Hitting this trend line, we got just above it right here. Look at the volume on the Williams again. Very small baby wave, okay? Not strong volume. As you can see, the actual size of the volume bars are extremely small. Guys, this was the largest inflow of retail traders. Retail traders, larger than the meme stock inflow. This is why you saw Coinbase rally, Peloton rally, ARK is up 28%. Granted, it's down like 80% on the year, but it was up 28%. This is why you see money flowing into risk assets. The big money isn't playing here, and it's represented in the volume. Now, they could step in. Remember, market conditions can change. They could step in and really move this up, okay? But I think where you're at here in a bear market rally, again, my view, in a bear market rally, there is more upside potential, but the bias, okay? It's always about confluence and bias for me when you're trading these markets up and down. The bias appears to be to the downside, representing some high probability trades. Let's try one more thing. Let's get rid of the fib. We see that we're at the 1 fib. We see that we have this great pattern. Actually, I'll just leave it. Let's throw our VWAP on the all-time high, our anchored VWAP of the Russell. Look what the Russell did here. It pumped just above the VWAP. Now, the pattern's in the way, so I'm going to go ahead and move this out of the way. But look exactly what it did before. Let's see if this pattern repeats. Pumped above the VWAP, sold off. Pumped above the VWAP at key resistance, key volume resistance. We have a geometric pattern here as well. Let's see if it sells off. So for me, guys, this is a high probability trade as well, with the pattern, with the volume confluence, open to short. We posted a trade in our Discord above 2,000. Nice $20 right now. But it gives you the advantage of free rolling this trade, moving your stop loss to break even, or if you are a scalper, taking a quick profit. But if we look at this as well on the daily chart, another way to express this pattern, our geometric reciprocal pattern coming up to 1988, as you can see. So either way I look at this, when I look at this here on the MFI, bearish divergence as well. Volume expressed as volume ratio, it's overbought for the price action. So lots of confluences showing me more downside is coming. Now, guys, let's go ahead and look at, by the way, our silver trade that I shared with you a couple weeks ago. I told you a good entry was 24.41. Since then, a 10% move down. Sometimes trading really is this easy. Series of lower highs. I know the metal bulls get very upset when I talk about shorting metals. Series of lower highs, adhering to this trend line, wick the trend line, 10% drop. Any amount of leverage. Money flow is going down to your median line. It's going to bounce at some level. You can look for a retracement here. You can pull a fib from the downside to the upside and look at that. But this has been a fantastic trade setup as well. If you want to see my price prediction targets for the metals, because they will come down before they go up, just like in the GFC, that video is my 2023 price predictions playlist. Guys, I hope you enjoyed this video. Definitely like, subscribe, leave me your comments, tick the notification bell, and the Bitcoin video is coming out next. Talk to you guys soon.